if you really want to trade the ICT concept, for sure you really have to understand about all his concept and what it really entails. So in this video we're just going to look at the ICT concept, okay? And if I can remember very well, there is an indicator by Lux Algo that shows us ICT concept, but if you don't understand the meaning of all this, even that indicator won't be beneficial. So that's why I've actually decided to break down the ICT concept, okay? So guys, the ICT trading methodology consists of some key concepts that every trader must know in order to take advantage of trading in his style. So in this video we will discuss the key takeaways as well as shown how to utilize some of these concepts. So guys, I welcome you to Money Close, the Forex Education YouTube channel. Maybe it's the first time you're hearing my voice. I really welcome you. Kindly join us by subscribing to this channel, clicking on that red button written subscriber, and definitely you'll be part of this amazing family, because I believe and honestly I know this is where you belong. If you're ready, part of this family, I really salute you. So guys, without further ado, I'm just going to talk about one concept that actually creates confusion, and this is what we call liquidity, okay? So in smart money concept, you're supposed to understand that liquidity is the first and indeed arguably the most important concept within the ICT trading methodology. There are two types of liquidity. We have the buy side and the sell side liquidity, just as you can see right on my chart right here. So if you can look closely on my chart right here, you can see we have the buy side liquidity and as well we have the sell side liquidity, okay? So I know most of you can really ask yourself, why do we really have the buy side liquidity on resistance and why do we really have the sell side liquidity on support, okay? And this is where most people go wrong. So let me help you understand why we have this buy side liquidity on this level and sell side liquidity. So I will start with the buy side liquidity. So the buy side liquidity represents a level on the chart where short sellers will have their stops positioned. So sell side liquidity is just the opposite of what we have seen on the buy side liquidity. So the sell side liquidity represents a level on the chart where long bias traders will place their stops. In both cases, these levels are often found at or near extremes at the tops and bottoms of ranges, are often viewed as areas where traders are proven wrong and therefore will want to get out of their trades. So that's what you're really supposed to understand about the sell side and the buy side liquidity. So I know now you have an idea what it really entails. So smart money players understand the nature of this concept and commonly will accumulate or distribute position near the levels where many stops reside. It is in part the sheer amount of stops at key level that allow a large player to fully realize their positions. Once the level at which many stops are placed have been traded through, it's often that the price would reverse course and head in the opposite direction, seeking liquidity at the opposite extreme. And this is actually happening on the level. You can basically see how actually the smart money understand the concept, okay? And they try actually to take all our stop orders, and you can basically see when it stop, the market actually proceeds to the downside. This happens at the level still, and you can see the market actually proceeds to the upside. So guys, that is concept number one. So let's go to concept number two. Concept number two is what we call displacement. In short, is a very powerful move in price action resulting in strong selling or buying pressure. So generally speaking, displacement will appear as a single or a group of candles that are all positioned in the same direction. These candles typically have large real bodies and very short wicks, suggesting very little disagreement between buyers and sellers. And I say this, I know most of you have really understood what it really means. Why? Look at this example. This is a very great example showing us displacement, and what we have really seen from the definition, you can see they are very huge candlestick pattern with very small wicks. Why? When we have wicks in the market, sure as that there was rejection from higher and lower prices, but at this given point when there is displacement, there is ultimately short wicks, and short wicks, as we can see right here, shows us a very little disagreement between sellers and buyers, and you can see probably that's why the market really pushes to the direction it is. Okay, so you can see there is very strong selling pressure. This is actually measured by the large candlestick pattern, and that's why we have a strong buying pressure actually measured by the large candlestick pattern at this given point. And that's what you're supposed to understand, that often a displacement will occur just after a liquidity level has been reached, and it will often result in the creation of both a fair value gap and a market structure shift. And this is basically what you're going to cover about the ICT concept, because you can see it actually resulted by the displacement. Okay, so guys, allow me to look at concept number 3, which is market structure shift. Okay, so as many traders know, the basics of trends say that in an uptrend the price is making higher highs and higher lows, and in downtrend the price is making lower highs and lower low. A market structure shift is represented by a level on the chart where the previous trend is broken. If the price is an uptrend, the market structure shift level is where a lower low is actually made. If the price is in a downtrend, the market structure shift level is generally going to be at a point where a higher high is made. In both cases, market structure shift tends to occur on the heel of a displacement. So guys, let's look at a great example over here that shows a market structure shifts. So this is a market structure shift. Just as we have seen from the definition, it occurs when a higher low is actually broken and a lower low is actually created, okay, or made. And this happens when the market is on uptrend. In our example right here, we can see we have an uptrend, and actually a market structure shift level is where a lower low is actually made, and we got this one over here, and market structure shift is actually created. So that's what you're really supposed to understand about this market structure shift. And those who are, once the price has traded through a market structure shift level, as a trader will start looking for further signs that the trend has in fact changed, using the market structure shift level as a level to trade off. So many people can look for opportunity to execute their trade, like for instance right here, and continue trading, or wait for price to really come back to the level and execute your sell order, depending on the strategy you use. So guys, allow me to go to concept number 4, and concept number 4 is what we call inducement. So really, does price move in a straight line? There is no at any given point we'll see price moving in a straight direction. Within a larger trend, there are almost always counter trend moves. These are counter trend moves are the result of lower time frame liquidity hunting. The price will bounce or get rejected and then will target a previous short-term high or low before continuing with the same direction as the longer term trend. Inducement is specifically the targeting of these short-term highs or lows as areas where stops might be placed. So let's have an example of inducement. To make you understand about inducement, they are like traps where smart money traders trick us to really execute trades. So looking at the example over here, you can see we had a structure over here where price actually broke to the above. So what smart money want us to believe in is that the market will proceed to the upside, and this fails and the market bounces back to the level, breaking to the downside, continuing with the same direction. So inducement is what we call traps, and you can see with the level actually shown with the red highlightation over here, you will see for sure there was inducement which was tricking us to really continue looking for a buying order. Our buying order, instead it actually reverses following the trend direction. So as we know, liquidity lies where an influx of stops are located, and once those stops are taken out, the price can continue in the direction it was previously going. For traders who are used to utilizing chart patterns, inducement can be seen in formation of bull and bear flags that you're really supposed to understand. Okay, so guys, let's look at our final concept, what we call a fair value gap. I know most of you know a fair value gap as FVG. That is actually very correct. So after the price reaches a liquidity level and then reverses, often what comes next is displacement. So fair value gaps are created within this displacement and are defined as instances in which there are inefficiencies or imbalances in the market. So the imbalances are visualized on the chart by our 3 candle sequence containing one large middle candle whose bordering candle upper and lower wicks to not really overlap. So a fair value gap is what we call imbalances. So with my example over here, you can see we have fair value gap, and most of the times we know many traders believe when we have a fair value gap, it's a holy grail, because they tend to believe the market will come back to the fair value gap and then proceed to the downside. But this may fail, and that's why with this example I've shown you fair value gaps that have been filled and fair value gap that have not been filled. Okay, so fair value gaps that have failed, basically I told you we wait for price to come back, fill the level and proceed to the upside. And you can basically, with the example we have right now, they are actually filled and actually seen with the green arrows over here. It shows you very clearly. And that's why we have fair value gaps that are not filled, and they are shown with these red arrows over here. And when you see red arrows over here, they tell you that this fair value gap have not been filled. How do you really know this? The market didn't come back to the level to fill the level. Instead, the market failed and the market actually proceeded with the direction of the market. This shows you very well that the price did not come back to the level. Still, the market did come back to the level to fill these fair value gaps. Okay, so guys, let me hope you've learned something from this video regarding the ICT concept. This is actually very important. Understand that many traders are actually interested in FVG because they can become magnets for price and future price action. And I told you this can happen and this may fail. Okay, so guys, bye, see you in my next video. Wish you nothing but the best. Continue working hard, because I believe one day your hard work will pay you. Subscribe if you haven't. Like this video as well, turn on your notification bell because you don't have to miss any of my future videos. So guys, what do I say? Bye, see you in my next video.